All right, Ken Orange Theory Trader back with another video on a CRT NR7 deep study. So let's get into it. So what is the NR7? NR strictly stands for narrow range. Okay, this is still the candle range theory. It's nothing new. But NR just means that it is a single candle. NR is going to be a narrow range made up of one single trading day. It's rooted on the daily chart. And it is where price moves less than it did any of the previous 6 days. Okay, so on the seventh candle, there'll be an indicator that'll note the tightest candle out of those seven previous candles. Okay, so or six previous candles. So it just means that the market has gone completely quiet and it's squeezing into a tiny narrow range, and it's usually an indication of price breaking out. So let's see how it looks. So you see here you have a daily chart. This candle right here with the yellow box around it, this day, okay, is the NR7 candle. So that means the six prior candles, out of them, this one is the most narrow or has the smallest range out of all of them. So what we anticipate is on the following day, which will be this day right here, we're looking for a price to break out of either side of the range. Now, this isn't where you're anticipating trend or anything like that. You're just looking for a breakout on either side, okay? But you're not going into it with a long or short bias, okay? You're just looking at you're just looking for price to break out. That's it. Now, simply put, the reason is this: small candle ranges lead to big candle ranges, okay? So we anticipate a big move after spotting a small, narrow range. Now, is this a departure from the three candle CRT? Okay, it is not. Okay, remember that the nature of the candle range, keyword range theory, is all about identifying range that can lead to profits. Okay, that's all you're looking for. But I found that after doing this for quite a while, it is without a doubt that the best odds of a big price move comes as a result of identifying a tight range. Okay, this, what I'm about to show you in this deep study, is going to help with that. Okay, so let's move on. The trading setup is as follows. Once you identify an NR7 day, the narrowest price range over the last 6 days or six candles, I know it says seven there, but I meant to say six. Okay. On the following day, you're going to watch the price action very closely. You're going to enter the price just above the high or below the low of that narrow day. So you're going to enter long if price breaks out above the range, and you're going to go short if it goes below the range low. Okay. You do not have to have a bias when an NR7 candle appears, okay? You will let the market make the first move, and you'll ride the momentum of whichever side breaks first. That's the goal with this. So this is a very simple, easy system, okay? You do not have to, there is no thinking required whatsoever. The most thought you'll put into this is where to put your stop loss, but that's about it. But we'll go over that. So here's the multi-time frame setup. This is how you'll look at this. So step one, you'll start on the daily chart and you'll find your NR7 day. That says 4, that should be 7. Okay. So you'll mark the high and low, and the indicator will do this for you. Okay, where you mark your range. On the 1 hour chart, you're going to wait for the close above the prior day's high or below the prior day's low. When that candle closes, you can enter your buy or sell trade. Now, if you enter on a 1 hour close, you don't have to necessarily put your stop loss all the way at the bottom of the daily range, because that could be a big stop loss. You can do it at the midpoint of the range. You could do it around the daily open if you want to base it around a fair value gap. You can take a look at the video called the only stop loss video you'll need, something along those lines. You have options, okay? Or you can just put it just above or below the 1 hour candle that actually broke out, okay? And that keeps your risk very small, okay? But if you want to experiment with lower time frames for your entries, you could do that too. All ranges are daily, but if you want to try the 5-minute, the 30-minute, the 15-minute, that's up to you for your actual entries, okay? So again, that's up to you. Now, the indicators that you're going to need for this, there's an indicator called NR4 and NR7 by Lux Algo. I disable the NR4 option, and there'll be a link in the description that's going to talk more about that indicator, a video for that, and Mark Levels by Mark Tools. So here's the master pattern right here. This is how the chart will look with the indicator in it. It's very simple. The elements of the chart are as follows. This box right here will show you automatically the prior day high and prior day low of the NR7 candle. Okay, the indicator will do this for you. The lines that extend from it are just the prior day high, once again, and the prior day low. And then the signal arrow. The signal arrow will appear when one of the candles closes below or above. This is a short example. The bottom of the range. In this case, it's bottom. You'll see a red arrow appear. That's your entry signal. Okay, do you have to have this red arrow? No. But if you just want to completely turn your brain off, if there was a robot that was be trading this, it would enter on this candle's close, or this candle's open. And when I talked about the stop loss, you could place your stop loss above this candle at the midpoint, or the safest stop loss would be above the range's high, but that's a pretty big stop loss, right? But this is what you're anticipating price to do, is straight drop. Okay, sometimes it will retrace into the middle of the range, but for the most part, this is the perfect type of scenario where it just goes straight into profit. Okay, that's how it you would hope it would look after this arrow fires right here. Okay, so there is no way that I know of to predict how big a breakout would be. Okay, once it breaks out, it can go for 40 pips, it can go for 100 pips. I don't know. Okay, I don't know. So let's get into some real chart examples here. So when you put the indicator on your chart, it's going to show a yellow box around the NR7 candle. So remember, for the past 6 candles, this range right here is the smallest. So this is our range where we look for a breakout. So this range was Thursday. Nothing happened on Friday because it was an inside day. But then Monday, right, because the range is still intact, there was a breakout of the range right here. Okay, so this green line, and it went for 45 pips before it came back down. So let's take a look at the smaller time frame. This is a 1 hour chart. And again, if you want to go to a smaller time frame, you can, but I like 1 hour. Okay, so the entry would have been at 10 a.m. See how it broke above the high of the range right here. Price up candle closed above it at 10 a.m. And the green arrow right here fired on the 1 hour chart. So this says, okay, enter. You are good to enter right here. Okay, so price went up 45 pips around here. It did retrace a little bit and then came back. You may have been stopped out with a wick right here on this one example, but does that always happen? No. Okay, but again, stop loss levels, you can put it below the middle of the range, below the bottom of the range. It's up to you, or below the candle that broke the high, which will be right in here. Okay, hopefully you see my mouse. But if you would have put your stop loss right here, you would have been stopped out on this candle. So just, but you could have just re-entered as soon as the candle closed because the bias is still good. All right, here's another example right here. We're going to look at this candle's range right here. So this is the NR7 right here from Sunday, Monday. The entry was at 2 a.m. Eastern Standard Time on this candle right here. And the price move was a 130 pip drop, okay, from this tight candle right there. So let's go down to the lower time frame. And you'll see here, so this is the range candle here. The entry would have been right here. This was the first candle that broke out. Okay, and here's the green arrow that fired. I'm sorry, the red arrow that fired right there. You would have had some drawdown on this trade because price did retrace, but a good stop loss level here would have been the middle of the range, because while you would have had some drawdown, eventually price did fall. And like I said, it fell over 130 pips on this example here. It's actually cut off from the screen. You can't even see it. It kept dropping so far. Okay, and the trade was still profitable. Okay, it went through to the next day. Okay, so this on this bigger chart, it would have been like a 2-day hold. You would have entered on this day, and it could have took profit somewhere on this day. Okay, so that was that one. That's the 1 hour chart of this daily chart right here. Let's see. Here's another long example here. So the NR7 day was Tuesday, which is this day right here. And then the best trading time was Wednesday at 9 p.m. Or sorry, Tuesday at 9 p.m. It would have been Wednesday in Asia, but where I am on the East Coast, it still technically would have been Tuesday, right? So that's why it looks like it's the same day, but it really isn't. This candle closed, and then this candle opened right here. Okay, so but I have to remember, with the market reset at 5 p.m. Eastern Standard Time, while it's Wednesday over there, it would like be the same day to me over here. Okay, but just the candles, that's the point. And this was a 79 pip move. So let's take a look at the entry. The entry was, let me see the time again, 9 p.m. So at 9 p.m., the candle closed outside. This candle right here closed outside of the range. Okay. And again, your stop loss, the tightest stop loss would have been the candle that broke out. So it would have been right below here. And then it just went up. And like I said, it was a 79 pip move. And that's it. Just a breakout of a narrow range. That's all you're trading. And once again, the green arrow fires on the lower time frame for the 1 hour chart. Here's another daily chart here. So we have the narrow range candle here on Monday, November 10th. The entry was at 3 a.m. on this daily candle here. And this moved 142 pips to the downside over 2 days, day one and day two. So the entry was right here. And like I said, a stop loss could have gone above this candle. That would have been your lowest level stop loss. So that was a pretty sizable 1 hour candle. So this is something where possibly maybe a lower time frame would have helped out. But at the same time, just you got to play it by ear on some of this stuff. It consolidated for a few hours, retraced, and then kept right on dropping through the next day. So this right here, this straightaway price action, is the ideal scenario from this entry. So that worked out. Now you can also trade both sides of an NR7 range. So I'll just give you one example here. Because remember, this isn't trend trading, you're just trading the range. If price breaks below it, you sell. If price breaks above it, you buy. So the first signal was a sell signal right here. So this is the first day. And this day right here would have been a trading day. That's this candle right here, or this chart right here. Okay, this would have been a 6 a.m. entry. Price broke outside of the low. And then you would have been out in like what, 1, 2, about 3 hours. You would have been done. But it would have been 54 pips. Okay. And then also you had a buy signal over here. Okay. And this is even on the daily chart. Okay. Where price broke above the range. And then you had a huge expansion to the upside. So that's this chart right here. Best entry would have been right here at 11 a.m. right there. And price rose 160 pips, okay, to the upside. So, but here's the range all the way back here. So this is the range that you were basing it off of. There were some other signals because you will see like the signal fired here, it fired here. Like you'll get, conflicting signals, and you'll just have that. I don't recommend always trying to trade both sides of the range. I'm just showing you where it is a possibility. Let's see. You can also add a trend filter if you want. Not required though. Some trend filters are like the 200 EMA, the 50 EMA, the 21 EMA, and the RSI with the catch. I'll go over that in just a second. But how trend filters work, in particular with EMAs on the chart, if price is above it, you'll go long. If it's below it, you'll go short. So let's show you how that looks. So this is the 200 EMA, and you could just focus on the red arrows. So you see here, you have a tight range below the 200, so you could have went short here, went short here. Let's see, right here, right there, right here. Okay. And there are still going to be some long ones, that do work out. It's just that the trend is down, technically speaking. Okay. If you use the 200. Then also you have the 50 EMA, which is this blue line here. So of course you would have, got some entries here, here. Like the best one being like this one right here. If you wanted to trade trend and guess would have traded this breakout here. I don't know how many pips this was, but that was quite a substantial move right there. So, that's the 50. You got the 21 EMA. And if you have a strong sloping line, that's always a good sign that where price is pointing up to the upper right side of the chart. So you have a strong signal there. This is a green arrow there, green arrow here, green arrow here, right here. Price was technically below it, but you get the point. I don't use trend indicators. I just don't, but you can if you want to. And then the RSI. Now, here's the deal with the RSI. I'll explain this and then I'll just move on because this is not going to be a video about the RSI. If I were to use the RSI as a trend indicator, I would treat it as if the signal line, when it's below the 50, it's a short trend. If it's above it, it's possibly long, which is this middle gray line right here. But if price is below the 20 line, I would treat that as a strong downtrend. I would not look for reversals in the oversold zone. Some people don't even mess with RSI, so you may not know what I'm even talking about. But I'm saying if the signal line was down here, I'm not trying to go long. I treat this as a very strong downtrend. So when you see this is like the strongest short signal you're going to see using the RSI. So you got a red arrow here, here, and here. But even from this first crossover right here, look at all that right there, right? So there you go. That's how I treat that. So let's set it up live real quick, and then we'll be done. So if you go to Trading View, you'll go to Indicators. You'll find this indicator right here, NR4 and NR7. You'll add that to your chart, like so. And this is what will pop up. This is mark levels is on here as well, but I'm going to get rid of that for a second. So let me start with a naked chart and start over. All right, so indicators, NR4, NR7. You don't technically even need mark levels, but I will go to settings and then just do NR7, and that's it. And here's a live trade right here. Okay, so you see you have your narrow day range, and there's the signal right there. Okay, so that's your entry right there. And already that would have been good for 70, almost 70 pips. Okay, this is a live chart. Okay, so entry when the green arrow appears, could have put your stop loss in there underneath the middle of the range. That would have been fine. And that's it. Very simple setup. So in conclusion, you can do your stop loss a few pips below or above the candle that breaks out of the range, or above or below the whole range as far as take profit goes. You can do a time based one where you can hold it for a day or two. You can do a fixed risk to reward, 1 to 1, 1 to 3, etc. You can do an ATR multiple. So if you're trading the 1 hour chart and price moves 10 pips in an hour, you can go for like 2 times to 3 times the ATR. So if it moves 10 pips in an hour, try to go for 30 pips. You can also do an NR7 range multiple. What does that mean? If the range is, let's say this total range right here is say 20 pips, for example, then you would go for like 60 pips, right? If it's 40 pips, you can go for a multiple of that, like 2 times the NR range, 4 times, whatever, like that. Let's see. But no matter what candle range theory you use, if you can't manage risk, you're wasting your time. Okay, everybody can trade. Anybody can press buttons, right? When they see arrows on the chart. But if you don't know how to grow capital, I mean, you're just going to be spinning your wheels. Risk management is always going to be number one. Okay, so but that's the NR7 trade. I hope you got something out of that. If you leave any questions in the comments below, and remind any parts that may have confused you, I appreciate your time and attention. Thanks for watching, and have a great rest of your day. Take care.